And welcome live to the LV Home Experts radio show where we talk about real estate and financing. If this is your first time tuning into this show, my name is Chakits Kruksawat, the host of the LV Home Experts radio show. Also a licensed real estate agent out here in Las Vegas, Nevada. I got my man, the one and only, the king of all kings, the root of all evils when it comes to financing, the co-host, Dan French himself. What's going on, Dan?
What's going on, everybody? Thanks for having me, Chakits. It's always a pleasure.
I love the kicks, homie.
Hey, that's my girl, man. I didn't buy them.
Oh, really? She picking out your clothes, too?
She's picking out my clothes, picking out my hats.
Got it. So today we have a very special guest. There she is, right there. The one and only Celeste. What's your last name, Celeste?
Harvey.
Harvey, that's right. I forgot. See, what a bad host I am. I like that. Celeste Harvey. So, Celeste, today we're going to be talking about real estate and financing. You are in the financing sector, correct?
That is correct.
What's the name of the company you work with?
I work with Fairway Independent Mortgage Corporation. I've been working with Fairway for about 2 years now, but overall I've been in the mortgage industry for 4 years.
Oh, wow. What made you even get into financing?
Wow. I was working in nightlife and I felt that it was time for me to start my career.
Yeah.
And I do have a degree in health communication, so I didn't have a background in finance at all. And I didn't know what I wanted to do with my life. And I just, was talking to my best friend on the phone, and she knows me the best, and she was working for a mortgage company at the time, and she said, Celeste, you have to be a mortgage loan officer. She was like, this is exactly what you need to do. She's like, I know you have the personality for it. You have the communication background. And she really felt that there was a need for someone like me to be a loan officer to help individuals kind of understand the financing aspect of purchasing a home. Okay.
So you've been in the business now, 4 years, you said?
Yes, that is correct.
How do you like it so far?
I love it. It's a very challenging industry. So when I started out, I was very green, and I started as a loan officer assistant, and I did all of the front end pre-approvals and lead conversion and stuff of that nature. And I did that for about a year. And that's really where I learned the bulk of my knowledge. And then so in March 2019 is when I decided, okay, I'm ready. I'm going to go out and I'm going to be a loan officer. And so all of 2019, I was focusing on originating my own business. And then, in March of 2020, we saw the pandemic happen.
Yeah.
And we saw a lot of changes in the mortgage industry. So this industry really keeps you on your toes. You're never having the same experiences over and over. And that's what I truly love about this business, is that I'm constantly learning, constantly facing new challenges.
Now, guys, if you guys have any questions regarding financing or real estate and would like to call live on the show regarding your question regarding financing or real estate, dial 702-409-4495. That's 702-409-4495. Or go ahead and type in your comments, and we will read your questions and answer any questions that you guys may have. Now, let me ask you this. On the financing side, it's got to be very competitive nowadays, right?
Yeah, especially with mortgage interest rates ticking up. We're seeing a lot of buyers out there shopping around. But one thing I do want to say is, who you work with matters. Finding a local loan officer in your area who has a good reputation, who can close fast, is your ticket to getting your offer accepted if you're, making an offer using financing.
So for a buyer, when they go out and they look for a lender, what are the things they should actually be looking out for? And can you kind of explain what is a lender? Because there's a lot of people out there that's watching this and don't even know where to start to buy a home, right? They don't know what a lender really is. So can you just kind of start from the basics?
Yeah, let's break it down. So a lender, let's break it down to this: a loan officer. That's the person you need to get in touch with, is a mortgage loan officer. This individual is going to talk to you. They're going to take your loan application. They're going to ask you a lot of questions about your finances, collect documentation from you, and help you get pre-qualified for a loan. They're going to help you determine which loan program fits you best. They're going to talk to you sometimes about your monthly housing budget, what you're comfortable with. And then once, they've verified everything, they're going to send you out shopping with, your pre-approval letter, and you're going to go out with your real estate agent and you're going to start making offers with this pre-approval letter. What you don't want to do is go out shopping without being, pre-approved first, because you need to make sure that you can afford the home that you're trying to buy. And
what I've noticed too, sometimes I will get calls where, they're doctors, attorneys, obviously they're qualified, but they're not approved. But I always tell them, like, hey man, you got to get approved first, right? And they're like, dude, I got an 800 credit score, I am going to get approved. My debt to income ratio, I know how this game works. But shit, you may not be happy with that payment. You know what I'm saying? Right?
Exactly.
Because just because you're approved for $2 million doesn't mean you're going to spend, $2 million. You know what I mean? What happens? Your comfort level is only $1,300 a month. Then that changes the whole dynamic of things. But now I want to go back, right? So a lot of times what people normally do now, or buyers will normally do, is just go online, and their main focus is interest rate. Wouldn't you say, Dan, like that's like one of the big challenges, right, for a lender in today's market?
I do. I
mean, it's very competitive, right?
I feel it's competitive. I mean, I'm sure you can attest to this as well, right? I mean, they go online and they think that's the rate. Rates are a moving target. It's all different. What people don't understand is loan level pricing adjustments.
Yeah. What is that?
It's just, it's like overlays based upon your credit, your overall position and where you're at.
Yeah.
So you get like this base rate, and then once priced out, maybe you have a 650 credit score. It's the fourth tier, right? You have the lowest tier on the credit score. Maybe you're putting 5% down. Maybe you've been at your job for only a year or maybe a couple of years. You haven't had like 8 or 10 years experience. All these things are factors of what really gives you the rate that you get. Also your occupancy, right? Primary residence, secondary home, investment property. If maybe it's a brokered option.
Man,
right?
You know what? You're spitting way too much, right?
Oh,
people are just way confused. Let's go back to the beginning here.
Sorry.
Oh, don't be sorry. This is great information. People need to know this stuff, right? So when you qualify for a loan, so let's start this from the beginning. What does the lender actually look for? Like, what are those steps?
I'll let you answer that. Yeah, go ahead.
Okay. Yeah. So, say I'm a borrower. I'm filling out an application. We're just going to look at the very basics. We're going to, you're going to put down your name, your legal name, your social security number, your birth date. We are going to look at your employment history. We're going to take a look at your income. We're going to take a look at your credit. So we're going to pull the credit. We're not just looking at the credit score. We're also looking at the credit history as well. We're going to take a look and see, do you own any properties? Have you owned properties in the past? Are there any past, bankruptcies, foreclosures? We're really going to do a detailed look into someone's finances, and we're going to calculate what's called a debt to income ratio, along with various other things. We're going to verify.
Oh, we got a super chat for $7.77. Thank you very much. I do
Vegas
appreciate
coins.
that. Vegas coins. How'd you know?
777.
Oh yeah, that's right. 777. Sorry for the interruption.
I don't even have to look at the screen. I can already know.
Yeah. So what we do is sometimes we do a super chat, and what a super chat is when a super fan gives us some money, right? We just stop everything and we just start screaming. It says, great to see you guys again. The home tours are getting to be more fun to watch every time. Thank you very much. I do appreciate you. Sorry for the interruption. Go ahead.
No worries at all.
That threw you for a loop, didn't it? You're like,
it
wait.
did. I was like, what is going on right now? They're screaming.
All right, what's going on?
You should have taped that. I wish York was in
I
here.
know,
She's
that
like,
would have been perfect.
What happened? Was there a fire?
Yeah, I was like, what's going on here?
Okay, so you were kind of giving the rundown of what what you guys look at
Yeah,
with
so
buy, right?
we're looking at a variety of things, and these aren't things that the consumers really need to know about. As far as like, they don't need to pre-qualify themselves. You know, you need to get with the lender, and that's the loan officer's job. The loan officer's job is to go through, collect all of the information, ask the questions, then collect the documentation, then, you know, pick out the loan programs that the client qualifies for, and then present the options to the client. So, you know, if you're a buyer out there and you're wondering, you know, what are things I should be working on to get myself in top tier shape to qualify for a mortgage loan? Well, number one, credit. The higher your credit score, the more likely you're going to be able to tap into better interest rates based on the market. So kind of piggybacking off of what Dan just said.
So let's start off with this credit score here. What's like a minimum credit score, and how does that work? Because I know that depending on the lender, there's certain requirements, and also certain type of loan programs may require a certain type of credit score. Is that correct?
That is correct, yes. So it really depends on the type of loan program that the client needs. So for example, if we're looking at conventional financing, yes, you can get in with as low as a 620 credit score. Now, is that interest rate pricing going to be beautiful? No, it's going to be awful. You're going to have awful interest rate pricing. If you have mortgage insurance, the mortgage insurance pricing is going to be awful as well. So typically, you know, if you are a borrower and you're shopping with a conventional loan, you know, we like to see credit scores above 700. That's where you're going to tap into better interest rate pricing, better mortgage insurance pricing, and that's where you're going to see more affordable mortgage payments.
Okay. Now, you also talked about credit history. How does credit history play a role in this?
Credit history is important, especially if you're using a conventional loan. Now, you may have, you know, a 750 credit score, but if you have limited credit history, sometimes we can see where we may not get an approval with Fannie or Freddie on a conventional loan.
So if I make $1 million a year, but I don't have credit history, but I got a good credit score, you're saying I can't get approved?
No. Not necessarily. No, there's all different varieties of loan programs. But what I'm saying is we're not just always looking at credit score. That credit history, the credit utilization, all of that, you know, plays into qualifying for a mortgage loan. You know, sometimes we'll see clients who have a lot of inquiries on their credit. Maybe they have like 27 inquiries on their credit, all of their credit cards, inquiries. So when a creditor, you know, pulls your credit, it's going to show up on the credit as an inquiry, and it's just basically letting us know, hey, they're out there, they're shopping, you know.
But who cares though? Does that really matter? Like, why does that matter? Dan?
As far as what, inquiries?
Yeah, like why does that matter? Who cares if I pull my credit like 100 times?
Well, one, it'll drop your score.
Well, I mean.
The other thing too is it looks like maybe you're just being a little bit sporadic. Right? You're just maybe a little bit not as responsible. Like if you're going to go and try to extend credit and you keep getting denied, starts to show up. I think that's part of it.
But what happens if I pull my credit because I want a certain kind of credit card, but I'm not getting the rates that I want? Then I keep pulling my credit. Or I'm speaking to one lender, I'm pulling the credit, and you're telling me something that I don't like. I go to another lender, I do the same thing, and I do it like 3 or 4 times.
Well, like, 3 or 4 times ain't that. It's when you're starting to get double digits is when you start to have issues.
Okay.
Yeah, so, you know, I've seen in the past.
Well, who pulls a credit 27 times?
You'd be surprised.
I mean, after getting denied like 3 times, I think like, hey, this is it, I'm done, right?
I can't talk about it, but I've seen it all.
Yeah, you know, sometimes you have people out there shopping for auto loans, and then they're also shopping for credit cards, and then they're shopping for mortgage loans, and so they're really out there, you know, increasing their debt. And so that's what we're looking for, those type of patterns too. We're also looking at the length of history. So maybe, you know, this particular borrower has only had a credit card open for 6 months, and that's their only credit history. Meanwhile, they have a 750 score, but they have, you know, high inquiries. And then, you know, let's just add, maybe they had a late payment. So, you know, the score might be in 750, but maybe we may not get an approval with a conventional loan whereas we'll get an approval with an FHA loan.
So it just depends on the loan, right? Because it seems
Yes.
like there's certain guidelines based upon the type of loans that are out there.
Correct. Yes.
You look at conventional loans; they're credit score driven.
Is that what it really
They
is?
really are.
That's where they start as a credit score.
They're
The
credit
first thing
score
they look
driven
at. Okay.
for the most part, and then when they run it through a system, it may give you what's called a refer.
Mm-hmm.
What she's talking about is that you get to get a desktop underwriting approval.
Mm-hmm.
Sometimes with the limited credit, they won't give you that. Now, what does that do? It downgrades it to a manual underwrite. Now you have an underwriter making the decision.
Let's go back for all the people that just don't know this. DU, desktop underwriting. What is that?
It's an automated system that really runs your overall picture of who you are.
Mm-hmm.
Just before it gets to an underwriter, they'll say this isn't going to work.
Okay.
Now you could still get a manual.
And what's
But
the
a lot of
difference between a
companies-
manual and
Well, you have
a DU?
You have an underwriter looking at these and
Okay.
making the decision. Now, a lot of companies won't take manual. It comes back to, does your company even offer manual underwriting or not?
Oh wow.
So then it may just deny you altogether.
Oh wow. So so what you're saying is you may be in a certain circumstance, right? Depending on your situation, one lender can actually get you approved, and another lender may not be able to get you approved.
Well, I'll let her answer, but we all govern under the same,
The guidelines.
the
But
conventional.
what
thing.
I'm saying is that there's some sort of overlay here between one lender and another. Because I've worked with some lenders where same program, same type of guidelines, but then there's an overlay. One company can do it and one company won't do it. You see what I'm saying? Is that correct?
Well, it is, but you got to still sell.
Yeah.
So they got to still insure against it, right?
Mhm.
So if you do that, and
Yeah.
let's say Fannie Mae or Freddie Mac finds that out, they can send the loan back to you.
No, I got you.
So and really what it comes down to is, what is the risk that the lender wants to take? Look, for instance, you can do condo loans, right?
Yeah.
People always say, well, you got, there's limited review, full review. And there's a lot of companies out there that won't do a full review, or they'll just overlook the fact that that doesn't meet the conventional guidelines. Even for FHA, they'll get the loan closed and then they go and sell it. They're like, wait a second. Yeah, you closed it, but this is not the bill of goods that we're going to insure against.
Now, Celeste, I want to talk about jobs, right? Like job history. Why is that so important? And does it matter if I got a good job now and I'm getting paid like $5,000 or $10,000 a month, but guarantee that, hey, I'm going to be working here for the next 5-10 years? I mean, why is that so important?
Well, just to piggyback off of what Dan said, is that we are all governed by the same, qualifications, the same rules.
Yeah.
So lenders require a 2-year work history. Now, that doesn't necessarily mean you have to be with the same employer for 2 years. We just need to see that you have a 2-year work history. So if you have a great job now and, you're making great money and you have that 2-year work history, typically, as long as you're a W-2 earner and you've been doing that for the past 2 years, we should be able to use your income.
So if you are a W-2 earner, the minimum requirement is 2 years. Could you do it with 1 year?
If you have a 1-year work history, meaning, okay, you didn't work the previous year before that, or let's just say you didn't work at all. Maybe you were a stay-at-home mom for the past 10 years, and then you just entered the workforce, and you only have 1 year work history. You're going to need to build that 2-year work history before we can qualify you for a mortgage loan.
Okay. But if you transfer from one job to another, that's okay. Is that correct?
Yes, that is okay.
Now, what happens if it's not like in the same line of work?
Then it really comes down to, pay type. For example, okay, maybe you were salary, but now you're switching to a job where, you're heavy in commission income or tip income, where your income is fluctuating. Then we'll have to see, 2-year work history with that fluctuating income. But say you were salary at one job and now you're starting a new job and you're also salary, it's a lot easier for us to qualify your income because we can prove that you have the ability to repay the mortgage.
You can always move that mic up like that. Yeah, there you go. Tilt it. There you go.
Perfect.
Oh, okay.
There you go. There you go. So, job history, big deal. But you mentioned W-2. Now, what happens if you are self-employed?
So if you're self-employed, there are a lot of options for you. So for example, let's say you're self-employed and you have a 2-year work history and, you've had a lot of write-off on your tax returns and you're just not really showing the income that you're making, there are things called bank statement loans. There's also investor cash flow loans as well, you know, if you're looking to purchase an investment property. So I actually do a lot of bank statement loans and a lot of investor cash flow loans as well.
You do a lot of those too, right, Dan?
Yeah, they're considered non-QM, but I think where people where they don't like it is the rates are typically higher.
Is it really?
A lot higher.
Yeah. They're a lot
Why
higher.
is it higher? Just because I'm risk?
Rates
But
are
I mean,
risk-based.
oh my gosh. So lenders feel more comfortable, or the banking institution feels more comfortable if you actually work for somebody on a W-2 versus self-employed.
Not always. I mean, I have self-employed borrowers who are
So why is their rates higher? That doesn't make any sense.
Well, look, at the end of the day, not to try to over talk her because I wasn't, but self-employment has the highest. They have had the highest default ratio.
Is it really?
Correct. So don't think banks aren't looking at all this data going, wait a second,
Yeah.
you know, like where's the problems lie? Where's the bleeding at? And that's where it's at more often because it's inconsistent income.
Yeah.
It's a month-to-month inconsistent typical income. So yeah, you're gonna have a little bit harsher. I feel that it's a little bit harder to get approved in some ways, and a lot of people do write income off, right?
Yeah, yeah. It really just depends on the way, you know, you're doing your tax returns as a self-employed individual. So, you know, if you're showing a lot of income on your tax returns, then you're not going to run into these problems with having to use a non-QM mortgage loan. You're going to be able to use a conforming loan like Fannie Mae, Freddie Mac, VA, and everything's going to be fine, right? You're going to be able to tap into the same interest rates that W-2 borrowers are tapping into. But what I'm saying is that there are other options out there where if you're having to write off more on your taxes, show less income on paper, there are options like bank statement loans. Yes, the interest rates are a lot higher.
Oh, you like that beat? I actually hit that on accident. Oops, sorry.
Is this the part where we dance?
Yeah, you and Dan's gonna be dancing.
Hey man, she knows the cue now.
I know
Did you see her
she
start-
does.
She started
Now,
doing it.
I'm
now
getting the hang
you
of it.
mentioned conforming loans and non-conforming loans. Okay, explain that a little bit. I think that's important for the audience.
So when we're looking at conforming loans, we're looking at, you know, VA, FHA. We're looking at conventional, which is backed by Fannie Mae, Freddie Mac. We're even looking at, you know, some of these jumbo loans too as well. These loans have stricter requirements as far as it goes for income requirements, credit score, debt to income ratio, stuff of that nature. So it's less risky for banks to lend on these types of loan products. So you're going to see better interest rates.
So for the conforming loan versus the non-conforming loans, the non-conforming loans would be higher on the interest. Is that correct? Because it's a little bit more risky and an investor has to get involved and it's a certain type of portfolio. Am I correct here?
Well, I don't want to answer for her, so she can go ahead.
I mean, we're all answering. You know what I mean? Come on.
No,
now.
I know,
We
but
can all answer.
Oh, Vegas coins, $7.77. Thank you. Now you can dance now. There you go. Let's do it again. Here we go.
she's got the Roomba going.
I know.
And she's like, is that
She's
what
good
they
with
call
that.
it? Rumba?
I'm not a good dancer, you guys, but I try.
I'm
Hey.
gonna do the night at the Roxbury like this.
Like
do
you're
that?
shaking water
Yeah,
out of
it's
your
like
ear.
this. You go out to the club, you're like this. You don't remember that?
Yeah, I do.
Saturday Night Live?
Saturday Night Live.
You don't watch that? That's what happens when you hit my age. You watch Saturday Night Live.
We got a couple comments here. We're going to read out some of these comments. And also, if you guys actually want to call York live, get on air with your question, with your situation, your financial situation. Because here's the thing. When you buy a home out here in Las Vegas, or no matter where you buy, right, we got to structure your deal the correct way. A lot of people think they just come out here and buy a home. It doesn't work like that. Give us a call, shoot us an email, or let us know in the comments. Let us know what your situation is. We can help you through the process. Dial 702-409-4495. Again, that number is 702-409-4495.
What if 495?
95. You live?
With a bowl of pho.
Okay. Hey, don't be talking about my pho. I got a question here. Okay. What do you all think about these lease to own home buying programs? You guys know anything about what lease to own is?
Yeah, go ahead, though. I'll let you talk.
Yeah, so I'm not super knowledgeable about the terms of these lease to own programs, but typically I advise my clients not to get involved with these types of programs just because I have a friend, for example. He signed one of these lease to own contracts. Oh gosh, I don't know, maybe like 5 years ago. And that contract was ending. And so what happens is in his situation was he was paying a higher amount for rent, a higher premium for rent. And then a portion of that money was kind of going into an escrow account that he would later be able to use towards his down payment for the purchase of the home. Well, the pandemic happened, he lost his job, and that contract was ending, and he wasn't able to qualify for the mortgage loan, and he ended up, losing the house and also losing all of the money that he had saved. Now, if he had just went out and just rented at the normal market rent, and he had just saved extra $200-300 a month in his own bank account, when the pandemic hit, he would have had that money to tap into to support himself. And then once he was back to work, he would have been able to qualify, for a mortgage loan. So I don't advise clients to get into these types of lease to own contracts, but, again, it's always up to, the client to do what they feel is best for them.
Let me just kind of break down what a lease to own is. So basically somebody owns a property. They can actually have a mortgage on it, right? And they find somebody that just has bad credit. And that person wants a property real bad. But they know that they're going to probably end up buying that property. You have to take a look at the terms to that, lease to own agreement, okay? So basically you're going to put a certain amount down. Let's just say 10 grand. Typically that's what happens, 10, 20 grand, certain percentage. Then you agree to pay a certain amount every single month, and a portion of that will go towards your down payment. But there's certain terms in there where is a balloon payment where you have to go ahead and fix your credit. And typically people that don't have good credit, they'll typically go that direction. But here's the thing, the savvy guys that are doing it, right, they're always going to win, right? And I'm talking about the landlord that's doing the lease to own. Because number one, they know that your credit sucks, right? And you got to fix your credit. I mean, if you already have to fix your credit, you might as well just get with a lender and learn how to fix your credit, right? Because a lender can help you fix your credit right away. Number two is that you're putting a chunk down. You're risking that money up front. And let's just say you have 2 years to refinance and cash out of the deal, right? To a traditional loan. What happens if you get tied into that situation? Now you'll lose that earnest money deposit or that down payment and all that principal payment that you put into the deal, right? Another thing that you have to watch out for is that a lot of times the price may be higher than the value. That's what you got to watch out for. If the home is only worth $200, they're probably selling for $250. The problem is this: if 2 years comes by and you did fix your credit, what happens if the home is not worth that much? It's worth less. So now you have to come up with additional money. Now, for me, I always tell my clients, like, dude, if you're going to go that direction, you might as well just rent for now, get with a lender, have them help you fix your credit, start stacking up your money, because in the long run, if you break down the math, it's a lot cheaper that way, right? It only works if you really want the property. And also the other thing that you have to take a look at is, does that owner actually own the property? Because technically, a lot of times what they do is the banks will actually own that property, right? They have a mortgage on it, but what they're doing is they're passing it on to you. If there's any sort of type of litigation, right? If somebody files a lien against that property because of a judgment, now you're tied up. Now your money's all tied up. That becomes another headache. I'm not saying this to scare people, but things like this can actually happen. I've seen it before. So it's just something to be aware, What are your thoughts on lease the option?
Yeah, I mean, I don't really deal with clients like that.
Yeah, or owner would carry. I mean, owner would carry is completely different, but that's a whole nother segment that we
That's a very small niche of the the market.
Yeah. And especially very with small. The way that the market is going right now, I mean, probably like less than 0.00001%. Like I probably put up on the MLS right now, there's probably like only 2. But it's like, why would you even put yourself in that situation? I mean, that would be the dumbest thing ever.
It's usually people that are inexperienced.
Yeah.
They don't have a clue of what's going on. They have nobody around them to educate them.
Yeah, maybe it's fear driven.
Oh, could be.
With, affordability, decreasing, our borrowers that maybe, like you said, have poor credit, maybe they have lower income, high debt. They might think that this is a good option for them, but really, I don't recommend it. I think it's more of a risky option. It's more likely they lose their money doing that than if they were to just, like I said, get a rental, pay market rent, and save, work on the credit, work on the savings, work on leveling up, finding a job that offers more income.
Now, I want to talk about, debt, right? I think this is important, okay? Student loan debt and medical debt. Now, if you have that, do they use that part of your debt to income ratio? Is that a compensating factor?
Yeah, student loan debt, we do take that into account. So even if you have, deferred your student loan payments, we're still going to calculate a payment for you just based on the loan program. It'll be anywhere from 0.5% to 1% of the student loan balance. And then we're going to plug that payment, into your liabilities and calculate your debt to income ratio. If you have medical debt, I just saw an article that came out that's what
I was going to get to. They're no longer using it, right? Did they pass that?
I believe from what I read, now quote me if I'm wrong, but I believe from what I read that if it's paid off, they're going to remove that from the credit report. Yeah. Because, sometimes you can have a collection or you can have a charge off and then, you pay it off, but it's still showing on your credit and it's still dinging your credit. Now, if they're going to remove that debt, that could be significant for some borrowers. When it's removed, it could increase their credit score. I once had a borrower, she had a really small medical collection. It was like $80 and dropped her credit score by 60 points.
Oh, wow.
When she took care of that and she got it removed, her score boosted up to the high 700s.
Oh, wow. Ooh. Do you guys still do rapid rescores?
Yes.
Yeah, but I just want to piggyback on what you're saying. All right. So
go ahead, please do.
What she's talking about is deleting the trade line altogether.
Yeah.
See, if you just pay it off, if it's not reporting, it's still affected your credit. It's not going to change your credit. It's got to act like it's never been there at all.
Yeah.
Secondly, on a VA loan, you can actually defer for 12 months. FHA, you have to apply the payment to 1%. Conventional, you still have to apply it. VA, it doesn't have to apply it.
Okay.
So
go ahead.
Also on medical bills, you run it through the system. For FHA, you're fine. Really what it comes down to, even if there's a collection there. Yeah. If it comes back and it's approved, FHA doesn't count that against you saying, oh, you got to actually remove that to get approved.
Okay, so that's a good thing.
Yeah.
So it's a good thing.
It really depends on what loan program you're using, as far as what the guidelines are for the debt. But if you're just looking at like your credit score, you're trying to get the best credit score, that's going to help, boost your credit score up.
I agree with her on that.
Now we're talking about loan programs now, right? I think we pretty much covered it. We covered what credit score, credit history, right? Jobs, the length of the job, right? Anything else am I missing that you guys actually will check a buyer? Oh, debt to income ratio. We didn't talk about debt to income ratio. Let's get into that for a second. Explain what debt to income ratio and give an example. How does that work?
So debt to income ratio, what we're looking at here is we're going to take all of your debts that show up on the credit report, and we're looking at not so much the balance, but of the debt, we're looking at the payment. So we're going to add up all of those payments, and then we're going to add it to your monthly projected housing expenses, and we're going to divide that by your income. And that's going to give us the debt to income ratio. Different programs have different debt to income ratio requirements, but typically, most lenders like to see the debt to income ratio below 50%. There are some programs where you can boost the debt to income ratio, above 50%, if we're talking FHA or VA. But for simplicity, I would say typically we want to see that below 50%.
Okay. So for conforming, obviously it's a certain percentage, right? Depending, right, on that conforming and that type of loan. But what about on the lending side? Does the lender have certain guidelines too, or is it just based upon that conforming?
So if we're looking at like guidelines from the agencies like Fannie Mae, Freddie Mac, FHA, all of that, we all have to abide by those guidelines. Now, there are some lenders out there that do have overlays. Some banks will not let you go above 45% debt to income ratio on, an FHA or a VA loan.
What about your company?
Whereas, Dan and I, the companies we work at, I know for a fact Guaranteed Rate and Fairway Mortgage, we could push that, well above 50% on an FHA.
How's about 68%?
Oh, yeah.
Oh, yeah.
You gotta show some green on that.
You probably should never go that high anyway if you had the opportunity, because why would you want to be house broke, right?
It really just depends on the situation. Sometimes we do have borrowers where we push it to 55% on a VA loan or an FHA loan. And as long as the borrower is comfortable making the payment, for example, maybe on the VA loan, the veteran or active duty military member is not married and we're not counting his spouse's income.
Yeah.
So there could be a double income that we're not counting on the application.
That makes sense.
We know, we can push this up to 55% and the borrower will be just fine making the payments. They're not going to be in a situation where they're going to be house broke.
Mm-hmm. Now, is there anything else that a lender looks at with a borrower? Did we cover everything here? As far as
for the most part,
okay.
Yeah, I would say, just to keep it simple, for the most part, I think we've hit the nail on the head with these are the main things that we're looking at. Now, there's always exceptions. We're going to look at, have you had a past bankruptcy? Do you owe money to the IRS? Do you have past foreclosures or short sales on your record? And we're going to dive into that. Do you own other properties that we have to now account for in your debt to income ratio? So I think if we got into all of that, it might be too much for the audience. Yeah.
Now, let's talk about loan programs. What are the common loan programs out there right now? So
for me, most of my borrowers are using conventional financing, jumbo financing. We're also using, I'm utilizing a lot of bank statement loans and these investor cash flow programs. I also do a fair amount of VA and FHA as well.
Okay, so what I see on the marketplace, we have FHA, VA, and conventional. Those are kind of like the standard. Jumbo, obviously, jumbo's out there just depending on the price of the home, right? But typically, what I always see in today's market is conventional. But I'm going to start off with FHA. What is FHA? What does it stand for? Okay. How much do you have to put down? And why would somebody use an FHA loan?
So let me start off by saying FHA is a great program. It stands for Federal Housing Administration. It's backed by the government. These programs are more affordable. You could put as little as 3.5% down.
Okay.
Like I said, they're more forgiving when it comes to credit. So, if you have a credit score in the 600 range, you're going to have a better interest rate. And, so that's the type of borrower that would be, using this loan mainly because, your credit's in the 600s. Maybe you have a past foreclosure or a past bankruptcy, and the foreclosure or bankruptcy seasoning is a lot less than it would be on a conventional loan.
Now, typically on these type of loans, you have mortgage insurance premium, right?
You have the upfront, and then you have the monthly as well.
So that's kind of like the downfall here is it's great that you get to only put 3.5% down, but then you got to pay this extra insurance, right? Dan, explain what that insurance is, please.
Well, it's really a fee, in my opinion.
So it's a bullshit fee?
I mean, it's not a bullshit fee, but it's more of like FHA is going to get paid too. Like it's really just about, it's like a processing fee almost for them. You want to call it, you have a loan that's like processors. It's almost like a fee just to do business.
Okay, so I always thought, and correct me if I'm wrong, I thought it was an insurance policy just in case if you don't make the payment.
Well, here's my thing. You're already getting monthly insurance, right?
Yeah.
Okay, so why would you need to pay that?
Well, I don't know. That's why I'm asking you. You're the lender.
No, I'm just saying just the concept of it. It's like if you're paying insurance and then you got another additional fee on top, well, can you justify why you're paying the fee? And I'm not saying it. Look, FHA is a business. They're going to do their deal. There's people out there that say there's a reason for this, right? That they do this, but
and those fees are pretty high. They're not low. That additional fee, right?
Yeah. So the mortgage insurance really, I believe, is in place in case of default.
Thank you.
So
that's what I was trying to get to.
If a borrower defaults, then that money, that has built up from all of these different FHA mortgages that were originated, that money goes and covers some of that default. And that's why, maybe we could see borrowers have better pricing on these types of loans because of that.
Well, I thought pricing was a little bit higher on FHA.
Well, I mean, like with lower credit scores. So like, for example, an interest rate on an FHA loan with a 620 credit score versus a conventional loan with a 620 credit score is going to be completely different. You're going to see a more favorable interest rate on an FHA loan than you would with a conventional loan.
Now, let's move into VA loans. What is a VA loan, and what are the pros and cons with a VA loan?
VA loans are my favorite.
Okay.
I just want to start by saying that. VA loans are for veterans and active duty military members. One of the pros of this loan program is that you can put as little as 0% down. So you can have 100% financing and there is no mortgage insurance. So the payments are a lot cheaper than if you were to utilize, FHA financing or conventional financing with less than 20% down. Yeah. And it's really out there for, those who have served our country.
And what was the county limit for FHA and VA?
FHA is around 420,000. VA, currently there is no limit.
Really? But you have to qualify, though.
Well, yeah, you have to be eligible.
Yeah. Well, I thought there was technically a county limit, right, or something?
If it's concurrent.
Okay.
So, like, if you're going from one VA to another, it usually mirrored what conventional loans did.
Got it.
So conventional loan 647, 200.
Now let's talk about conventional, because now conventional you have 3% down, right? 5%.
First time home buyer. You have to be first time home buyer to put 3% down. If you're a non-first time home buyer, you're looking at 5% down.
Okay, so let me ask you this: in today's market, if I came to you and I had the option, I can go conventional at 3% down or FHA at 3.5% down. How do I know which loan works for me as a consumer?
Well, I take a look at your loan application. I'm going to take a look at your credit. I'm going to take a look at your credit history. And based on that, I'll start recommending one program over the other.
Yeah.
So, for example, if you have a 750 credit score, I'm going to recommend a conventional loan for you. And the reason being is because the mortgage insurance is cancelable.
Oh, so what does that mean? Because typically when you're doing this at 3% down on conventional, there's that mortgage insurance, but you're saying that you can actually take it off?
Yeah, so let me break it down. Let's just talk about mortgage insurance here for a second. So on an FHA loan, if you put less than 10% down, the mortgage insurance is on the loan for the life of the loan. You have to refinance out of an FHA loan into a conventional loan to remove that mortgage insurance. Now, if you put 10% down on an FHA loan, that mortgage insurance, I believe, is on there for about 11 years, and then it falls off. So if you're, shopping for a home loan out there and, you have a credit score, 700 plus, typically you're going to want to go for a conventional loan, if you're putting less than 20% down, because the mortgage insurance is cancelable, which means when your loan to value reaches 80%, you can call your mortgage servicer and say, hey, I want to remove this monthly mortgage insurance.
So you have to tell them, they won't take it off for you?
You have to tell them at 80%. Otherwise, it'll automatically fall off at 78%.
Okay, so now the question is, do I need to get an appraisal at that time in order to have them remove it?
No.
Okay.
So it's going based off of the home value at the time you purchase the home.
Mm-hmm.
Now, I have heard of some clients, talking to their mortgage servicer and getting it removed early by ordering an appraisal. And at that point, it's servicer discretion, like as to what their guidelines are for removing it. I know my sister did it. Her home, her loan to value was about 68%, and they removed it for her.
So Celeste, let me ask you this. So what you're saying, you can remove it if you did a conventional at 3% down, as long as it hits that loan to value at 80%, correct?
Yeah. So let's think about it this way. So say, you're out there, you're shopping for a home, you don't have 20% to put down, because on a conventional loan, once you put 20% down, the mortgage insurance goes away. There's no mortgage insurance. But let's say you don't have 20% down, but you have 3 or 5% down. Go ahead, purchase the home, and as you pay your loan balance down to as if you had put down a 20% payment over time, that's the point when you can remove the mortgage insurance. And all you have to do is look at your amortization schedule and figure out at what point do you reach 80% loan to value.
So based upon what you're telling me, FHA at 3.5% down or conventional at 3% down, you're better off right off the get-go going conventional at 3% down. Here's the thing. A couple things, right? You're putting less down. Number 2 is you can get rid of that mortgage insurance premium.
Yeah, but that's not always true.
Hold on. I'm just saying, based upon what I'm seeing here, right? And if you have a good credit score, you're probably going to get a better rate on the conventional, right? And also in today's market, depending on your market, majority of the time, 95% of the homes that are closing, they're technically going to go conventional versus the FHA offer.
Yeah. So I think Dan was trying to say is that, even if you're a first-time home buyer, you could put 3% down if your debt-to-income ratio is below 45%. Once you go above 45% DTI, it's an automatic 5% down.
Okay, Dan, you want to go ahead and elaborate on that?
Sometimes you don't. First off, you don't get approval all the time at 3%. That's the number one thing.
Okay.
Secondly, you're going to get a higher rate probably.
Really? On a conventional? Why would I get a higher rate?
Because it's more risk to the bank. So that doesn't necessarily always mean that you should do that. Also, too, your insurance might be higher.
Oh, didn't know that. I thought it would just be better for me because I'm only putting down 3% versus 3.5%.
Case by case.
And based upon today's market, right? The benefit here is that I'm probably going to get my offer accepted. And the last and final benefit is that I have the opportunity to get rid of that mortgage insurance premium.
Yeah, so it just really comes down to the home buyer and what makes sense for them and where their finances are at. And that's really the job of the mortgage loan officer is to, show you what your loan options are, versus putting 3% down versus 5% down, what that interest rate looks like, what that mortgage insurance rate looks like. There's going to be a difference there. So the fact is, though, that for borrowers who qualify, they can put as little as 3% down as a first-time home buyer.
Okay, so Dan, what would you advise a buyer? Would you go 3.5 or 3% down in today's market? Conventional or FHA?
She explained it very well. I would say,
I'm asking your opinion.
My opinion would be, what does the client want to do based upon what assets they have, and then that's pretty much it. So.
Yeah, I would say in today's market, we're seeing sellers be more favorable towards conventional financing. And I believe it's because they know that the requirements are a little bit stricter with conventional financing. So you're going to get a more qualified buyer, less risk of maybe financing falling through or stuff of that nature. Yeah,
I would agree to that. Absolutely. Chuck, you got a lot going on over there, man. You're shaking and baking.
Yeah. You know what? We got so much going on. I got the phone ringing right now. We got a question on the phone. Unfortunately, we can't dispatch them because we got the wrong phone now, York. What's going on? You see what's going on here? I'll take the blame. No, that's actually my fault. What was the question, actually? Let's read off this question here.
This is Joey's client. They just basically closed on a property last week. Question was, he wanted to know, is there a timeline that they have to wait to be able to purchase an investment property through a loan now?
You know what? That's actually a good question. Here, why don't you take the mic?
No, you heard what I said.
No, I didn't hear what you said. What'd you say? Go ahead. Right into the
Do
mic,
a
York.
close up on York. York,
there you go.
I got to see a close up. Can
Yeah,
you
go ahead, York.
Go ahead, York.
Here.
York,
Christ, dude.
let's see it.
There you go.
Thank God. Okay, so the question is by Ver, which is Joey's client. They just purchased a property last week, and he wanted to know if there's a timeline that they have to wait to be able to try to pursue an investment property through a loan.
Good question. It's on you. Take it. Somebody take it.
Okay, so he just purchased a home. Was it a primary residence? Do you know? Or did he purchase an investment?
This one is a primary residence.
Okay.
Yeah, it is.
Yeah, so it really just depends. Does he qualify for an investment property? If he does, yeah, he could purchase it right away. There's no restriction.
Okay. So, hey, that property that he just purchased, Dan, because I think you did the loan with him, right, on this one?
Oh yeah. Is it Veristar?
Yeah. So,
Oh man, you guys. If I'd have knew it was Veristar, I would have went over there and said hi.
yeah, the problem is I had the wrong disconnect. Hey, you know what?
Which is my fault.
No, it's my fault. Make sure that we get a new coax that actually connects to that, so that way we can bring them live on the. Okay. Thanks, man. I appreciate it. Sorry about that. Such a dummy.
What's going on?
Well, the problem is that we used to have another phone, right? And as we get calls, we would just connect them to here. But this jack here is completely different because we just got a brand new phone, and it's the USB-C. So that's where we messed up. So telling all these people to call in, I mean, they're calling in right now, and basically we can't even connect people. Oh, sorry about that, guys. But you know what? We can always do this. Take some questions. Wow. Let's see here. Let the experts on the mortgage explain, not what you see. Oh, looks like these guys are fighting here on the comments here. What the hell's going on? Let me get a question here.
Who's winning?
I don't even know. I'm not even going to get into this.
Some
of these guys. I'm recently refinancing from a VA2 into an FHA loan, and now I'm paying this extra monthly $280 of mortgage insurance fees. Why would you refinance from VA to FHA?
To free up the eligibility so they can do another VA loan.
Yeah, but it's not like you could do it in the same state, like 10 miles, right? Because I think you got to be a certain distance, right?
No, it just has to have the eligibility. The VA, if you give eligibility, the VA gives it to you.
Yeah.
Then what he's probably going to do, or she, probably going to go buy another primary residence, maybe an increase. She said there's no limit. Now you can get into a house again with using your VA eligibility.
Now, yeah, but wouldn't you rather just refinance into a conventional loan?
Not necessarily.
I would.
It really just depends. It's hard to answer that.
You got to look at the full circumstance.
Yeah, you really have to look at all the details to determine what makes sense for that borrower.
Now, also, when it comes to like financing, you really got to play the game, especially in today's market. Because I remember when I first bought my first property, I think I was sitting at 5.2%, and I did a buy down, and I thought I was a hot shit. Like, yo, I'm the shit.
You don't.
My thing was I think I went from 5.2 and I bought down to 4.9. I literally thought I was the man.
Were you popping your collar?
Oh, like this, all day long.
All day, huh?
What year was that?
Dude, it was 2009. My wife was like, dude, why are you buying down? I was like, don't worry about it because we're going to lock in this rate. I thought I knew what I was doing. That shit tanked, dude.
Oh, I thought you were like, we got into an arm.
And
we got into an arm loan.
Market tanks. And I was just new to the game, right? Market tanks. And it goes down to 3.2%. I refinanced from FHA to conventional, which is the best thing ever. Dude, I saved $400, right? And I still have that payment till this day. It was the best thing ever. But I should have listened to my wife. I spent an extra $4,000 for a buy down for nothing. Lender got me on that one, man.
Well, here's my thing.
It's crazy.
There's the time to do that.
Yeah. I mean, you got to also time the market too as well, right?
Somebody that probably did the FHA refi is because their credit didn't qualify conventional. Yeah. Probably. Because it is better if you do conventional because you're not going to have insurance if you have the equity. So what probably happened was, I can't get into conventional. I don't have great credit or something's wrong. I'll just settle for doing FHA because that's like that. You didn't make the cut, right? Credit score is not good enough. We can still throw you in there at an FHA. You'll be good. But that county limit, you ain't going over 420.
It's kind of hot in here, huh?
It's always hot in here.
I tend to do that a lot. That's supposed to be a joke, guys. Now, refinancing. Let's talk about refinancing because we don't see too many refinancing anymore, right?
I still have borrowers who are refinancing, but the volume of refinances has gone down significantly because we are seeing mortgage interest rates tick up recently. And so that has kind of dried up some of the refis.
Now, based upon, last 2 years, interest rates were so low, it seemed like everybody refinanced. It almost seemed like the whole market had refinanced. I mean, I don't even know if you can go any lower at this point. Do you think the refinancing sector is completely done? Because I mean, you can't go any lower anymore, right? And I felt like everybody just refinanced.
Really just depends. I mean, I have some borrowers who are not refinancing to lower rate, but refinancing to take money out, to purchase other properties, pay off debt, stuff of that nature.
That could be a little bit dangerous though, right? Because we're going back into what, 2008? If you're refinancing or cashing out refinancing?
Well, we talk about, I mean, the difference is what does the mortgage payment jump to?
Yeah.
Right? So if your payment, if you got a 3% rate and you're jumping to 5%.
Oh, that's pretty steep though.
I mean, yeah. I mean,
well, depending on your balance of your loan too as well.
You're
right?
freeing up, let's say you pay off some debt. Let's say you free up, I don't know, you have $800 of debt every single month.
But yeah, if you're refinancing, if it was $400, then you're still saving money. That's what you're saying.
Yeah, you're still saving money, but now you're starting the loan all over. Now there's interest. I mean, look at, man, we can get technical, but I'm just saying the point is that, is it making a lot of sense to people to do it? Yes, in some cases. Look, if you have a non-QM loan, right?
What is that non-QM?
Well, it's a deal where it's like, let's say it's a bank statement program, it's 8% rate, something like that, or you had to get into a hard money deal.
I don't understand what you're saying,
right?
Man.
All these things. So, but look, there is some options for people to still do that, but that's like the outside of the box type thing.
What challenges are you having right now? When interest rates have gone up. I mean, what was the last interest rate you locked in?
I just locked one in for about 4.75%.
Man, why is our interest rate a lot better than yours, bro?
This borrower,
mine start out at 7. So.
Let me mention this borrower.
You
putting a lot of money down.
You know what? Look, this is gonna be funny. Next week, she's gonna be sitting over there. They'll be like, "What happened to Dan?"
You better watch out. No, I'm just kidding.
Who wants that 7%? Ring my phone up.
Hey, I can't do that. Dan's gonna be so jealous. Like, oh my god.
No, I think
wouldn't
there's
do
more
that
than
to Dan. I actually really like Dan.
Yeah, I always like.
Yeah, we had a nice powwow.
Yeah, that's good.
Yeah, he's a good dude.
Yeah, he is.
Yeah, so you be nice to Dan.
I can't. He's like my brother. I always gotta,
We go back and forth.
Yeah, we go back and forth. Yeah. Trust me. Sometimes he gets under my skin. Oh man, once I blow up, I blow up.
We take a couple days.
Don't talk to me. It's like a relationship.
Are you guys married now?
Yes. Obviously, I'm the man in this relationship.
Oh, yeah.
Look at that. You see the muscles?
That's the baby that we have together.
All right.
Just like,
hey, you going to hell, man. That's disrespectful, homie.
God.
Now, is there any tips that you can share for somebody that's out there, thinking about buying a home and what they should actually do to get started? Or how to find the right lender? Yeah,
I highly recommend working with a lender who has a good reputation. So, working with someone who's local, not so much an online lender. In today's market, it is helpful if your lender can push you through underwriting in advance so you can get an underwritten pre-approval. And then you can get out there and you can close in as quick as 15 to 17 days. With that, you can shorten some of your contingencies. You can shorten your appraisal contingency, your finance contingency. Yeah. This looks a lot more attractive to a seller and can kind of help you compete against other finance offers or even cash.
So a couple contingencies that in today's market, based upon customary practices, is the appraisal. Typically, that's about 21 days, anywhere from 18 to 21 days. Then we have the appraisal contingency. It's roughly about 25 days. With you, by doing the homework all up front with your client, collecting all the information that you need, what is your typical turnaround time for the appraisal, okay? And also with the full approval.
So let's just say I have a client who's coming in, we do everything up front. For appraisal contingency, I'd do about 10 days.
Damn. You out of here, homie.
But
You
keep
out.
in mind, I'm rushing that appraisal, so there's an
Okay.
additional fee.
Who pays for that fee? You?
The client, the borrower.
You pay for that fee?
Oh, no.
Oh, okay.
The client's going to pay for the additional fee.
Yeah.
But, this is what you have to do sometimes to get your
Yeah.
offer accepted in
So-
this market.
So how much is the fee? And if I did do the rush, what's the addition on that?
So an appraisal typically costs about, let's just say $475. You rush it, $200 rush fee. So what is that? $675?
Okay. That's not that bad.
It's not that bad. It's not that bad at all. I think it's 100% worth it. So I would do about 10 days on your appraisal contingency, and then the finance contingency, I would do 15 to 16 days with a 17-day closing. So if you're coming in hot like that, and you're making a competitive offer, because you got to get with your
speed.
real
It's
estate
fast.
agent
It's fast. Yeah.
and ask,
That's good.
okay, what else do you have to do, because you're probably going to have to offer over list price as well.
Yeah.
And I see some borrowers out there, waiving their appraisal contingencies altogether. I just got a contract on Monday, and I was kind of shocked because I saw that the client had waived the appraisal contingency and the finance contingency.
That's crazy.
And we're going solely off of the due diligence. That's the only protection that they have covering their EMD. So I'm slamming that through underwriting. I'm making sure we get as much as we can cleared by underwriting before that 7-day due diligence period is up.
Okay. And you also mentioned lenders in state versus out of state. And I think this is actually very important because a lot of people end up going to Rocket Mortgage and stuff like that, which is, they're great companies.
Who's that?
I don't know. But anyway,
The
Wells
greatest
Fargo.
marketing company of all time. They're great at marketing.
Oh, they're good. They're good at marketing.
But at doing mortgage loans, it's very hit or miss.
No, it is, and it depending on who the lender is. If they're savvy, they can get things done. But the point that I'm trying to get across is that when you deal with an online company like that, you may have that loan originator or the lender. He may be licensed in multiple states, but he may not know the customary practices. So I know some lenders are stronger than others as far as they can go to the underwriter and say, yo, I need a favor. I got to push this one through. I need your help. Because if I don't, my client could lose the money, right? And that has happened, sometimes, And that's why, I think a lot of agents, they really vent their clients and they always push their clients, hey, use this lender. And it's not because they're getting a kickback or anything like that. It's because they worked with the lender multiple times and they know that they can get the deal done. Right. So I think it's very important that you do work with a lender, within your state. It's just so important because you can get that deal done and they understand customary practices. It gives you that much more leverage.
Yeah, I mean, if we're looking at online lenders, they don't have anyone holding them accountable. So, like I said, greatest marketing company of all time. They're getting a lot of calls in for consumers who are looking to pursue mortgage loans. Whereas Dan and I, we're 100% referral, where we're getting all of our clients from real estate agents, referrals from past clients, friends, family, and our reputation means everything. They always say you're only as good as your last deal. So if we're making a mistake,
You know what? I just had a thought, and I think this is a good idea. You guys would be pretty good together if you guys partner up. You guys ever think about that?
I don't know. I just met him today. I don't know if I'm ready to join the marriage quite yet.
She seems like Fairway's treating her very well, so I can't really say anything about that one.
That'd be funny if I contact you one day. You're over at Fairway.
Yeah, right. Where'd you go?
So what's the best way, and how do people get a hold of you?
So the best way to get a hold of me is on my cell phone. I use my cell phone for personal and business. My phone number is everywhere. So if you need to contact me, 702-715-9061. Shoot me a text.
I definitely will put all your contact information in the link in the description. So that way, if anybody has any questions, want to get into financing, I'll have them reach on out to you. I want to say, first and foremost, I do apologize that I was actually late to my own show. And the second thing is I really do appreciate you taking your time, coming out here and educating the public as far as when it comes to buying, type of loans, everything that you need to know about financing. I really do appreciate that. You didn't have to do that, but you did, and that's really big, and I really indebted to you. So I do appreciate you, and hopefully you can come back again, and we can talk more about financing.
I'd love to. Thank you so much for
Cool.
having me.
Now, guys, if you guys have not had a chance to subscribe to the channel, go ahead and click that subscribe button. Also, don't forget to check us out on our Instagram page too as well. We just hit 6,000. We're trying to get up to the 10,000. Again, I will have all the links in the description below. Other than that, thank you so much for tuning in. I'm Chakits Kruksawat with Simply Vegas, and be blessed, folks.